with some good points, I think, from your guys' outlook. Peter, thanks for being here this afternoon.
Thanks for having me, Oliver. Great to be here.
Let's take it point by point. Number one, presidential election, fresh on our minds from yesterday. Do we have any clear idea just yet how each of these men would affect the economy?
Oliver, that's a fantastic point, and we still think it's too early. What we saw last evening was very unique, where we got our first debate that happened much earlier than expectations. Typically, we do see political uncertainty and volatility rise heading into the presidential election. But what's important to us is if you look at the 1 year after the presidential election, markets are typically up 16% the 1 year following that election. So irrespective of which candidate gets into the White House, we think even with this near-term uncertainty that we could see, it's worthwhile for investors to try to stay invested through markets, invested through this near-term noise in order to get the return profile that we can see after the election.
Everybody last night wants to blame the other guy for the deficit, and it just keeps going up anyway. Do you believe that type of thing matters if they're both going to come in and try and impress with big fiscal promises? It's going to run it up even further when we get closer to that election. Does that matter?
Oliver, I think a big part of that, too, which gets back to the uncertainty point, is, depending on which candidate gets into the White House, there are also a lot of elections relating to the Senate, but also to the House races. And we don't really know who's going to control the majority there. So even if these candidates have these big policy proposals that could impact the deficit, but also the debt spend in our country, it's going to be important to see what the makeup is of Congress, because that's ultimately going to determine what gets passed through Congress. So we think those races are going to be just as impactful, and just given that there are so many of them, it really is uncertain of which party is going to control Congress at this point. So it's still too early to determine, and that's why we'll probably see headline risk increase going into the election.
I guess another way to frame it, and at the risk of probing for too much hypothetical here, but if we just kind of think of one of the main driving forces for markets being the huge amount of fiscal support since COVID, going through, into, and out of COVID, so that's both Trump and Biden, it seems like maybe then it's almost like a binary analysis. Is that rate of change for fiscal support going to go higher, lower? Do you have a strong feeling on whether or not that rate of change of fiscal support could deviate in any meaningful way?
Oliver, we don't really have too strong of a view there. If you actually look at the Hutchins Institute from Brookings, they actually have a fiscal impulse measure. And if you look at that over the last few years, it's actually been more in a neutral position. So in the aftermath of the COVID, we saw the fiscal impulse move significantly higher, and that was very additive to GDP here in our country. We did see a slight fiscal drag after that, and then since then, it's really been in this neutral regime. So I think there's no reason to believe why that couldn't change too much.
Okay.
So we'd really expect that impulse measure to remain neutral over the few years coming.
Good answer. So kind of a status quo, basically, when we're doing the analysis. You guys talk about two tail risks going forward for this year. When I think about trailing tail risks, it was either surprise reinflation or like recession deflation. A lot of folks have argued we've lopped off that more inflationary tail risk. Do you guys feel that way?
Yeah. Oliver, I think so. If we look at where growth has come in over the last few months, there's definitely been a bias towards growth weakening. If you look at the Bloomberg Economic Surprise Index as well as the Citi Economic Surprise Index, those are both at multi-year lows. If you look at the GDP print that we got, or the last revision of GDP that we got this week, we did see a 50 basis point reduction in consumption. And the Atlanta GDP nowcast is in that 2.2% range. So while still above trend growth, that's come down quite meaningfully from where we were at the start of the quarter. So I do think that the tail risk is probably more towards growth being weaker than it being kind of in this no landing environment where growth remains really resilient and inflation remaining sticky. And I think we saw that even with this morning's core PCE print, where we did get an inline reading of 0.08% month over month. And we think that measure should probably give the Fed a bit more confidence. But thinking about this soft landing view of growth returning to a trend rate, but also inflation returning closer to the Fed's target.
Okay.
Those are some of the ingredients that we'd be looking for a soft landing.
Okay. Those are, if we get that soft landing, right, positive thing, if inflation comes down with growth, and you kind of addressed two of your other three remaining points, which is slowing consumer, which I think we've already kind of seen a good bit of that to some degree, right? Regional banking stress, the charts certainly don't look good, but you guys believe that that stress could reignite. So with our last kind of 45 seconds, let's hit the AI thing, Peter. Is there such thing as rotation in this market? Could we rotate away from AI, or is it do or die on the NVIDIA train?
You know, I think NVIDIA is like Scotty Scheffler's golf game. It's just been very strong this entire year, but we really do look for
come to an abrupt arrest.
We look for the AI trade to broaden out, and I think where we look for the beneficiaries in the coming quarters would be utilities with the power theme, as well as the software theme and the Gen AI potential there. And software looks like a very cheap option on the Gen AI monetization potential.
Okay, so we'll shift over. They won't get disrupted. Disruptees?
I'm not necessarily sure what the disruptors are. It still feels like it's pretty early to tell who's going to be disrupted.
Fair enough.
It still looks like the pick and shovel names are going to be very strong. They've been spending a lot of money on CapEx. But it's really more looking to what other sectors could benefit from this AI theme, where that's really where we are really looking for the potential of this theme to continue throughout the remainder of the year.
All right. Peter, thank you very much. Appreciate the walkthrough.
Yeah, thanks, Oliver.
Yeah, absolutely. Peter Repetto, Vice President and Investment Strategist at iCapital. All right, some good closing macro thoughts for the first half of the year.